Hey people, I welcome you all to Caroline's Online Academy, and we are currently solving realization-based problems in the series of videos in which I'm solving dissolution of partnership firms problems from previous year questions and sample question paper questions from 2014-15 till 2023-24. And now we're starting with realization account from this video. This question that I'm going to solve is the 47th question in the question bank, which has been uploaded in the drive, and the link to the drive is in the description of this video. This question was asked in 2023-2024 attempt in the All India paper. It's a very small 4-mark problem, and it's a very simple problem. I think it would be better. It would be nice for us to start with this one. In the process of learning realization account. The concepts and theory that is involved in the journal entries that we are doing and the logic behind the journal entries and all will be discussed in the concept video for this chapter, which I'll upload shortly. But as we are nearing the board exam now, all that would have been taught to you already. So I'm just going to solve the problems now and give as much information and as much logic to it as we solve the problem as possible. And we will be coming across all different kinds of adjustments that are usually asked in the exam for realization account, because we're going to be solving all the questions from the previous year question papers and sample question papers on realization account. So we will be going through enough adjustments. So if you just listen to these videos, you should be able to tackle any realization account problem that you might have come across in the examination. So yeah, we have Archana, Vandana, and Aarti were partners in a firm sharing profits and losses in the ratio 5:3:2. Their balance sheet as on 31st March 2023 goes as follows. We have capitals, Archana, Vandana, Aarti, and then we have general reserve, creditors. We have investment plan, stock, debtors, and cash at bank. The firm was dissolved on the above date. Assets realized as follows. Debtors 40,000, stock 50,000, and plan 60,000. 25% of the investment were taken over by Vandana at rupees 18,000. Remaining investments were taken over by Archana at 10% less than its book value. Expenses of realization were paid by Aarti. This is a very simple problem with very, very basic adjustments. Let me go ahead and solve this for you so you understand how simple this is. The first thing to do in a realization problem would be to transfer the assets and liabilities to realization account. Now, which all assets will you transfer? In the asset side, you're supposed to transfer all the other assets, all the assets other than cash at bank. You're not supposed to transfer cash at bank. You're not supposed to transfer accumulated losses if they have been given on the asset side. And you're not supposed to transfer loan given to partner. Other than that, all the other assets are supposed to be transferred. Now, in this question, we have investment plan, stock, and debtors, and cash at bank is there, which is not supposed to be transferred. So all of these assets will be transferred first. So what do we have here? Transfer the asset. Now, to which side of realization is supposed to transfer the asset? To the debit side of realization account. To investment account. To stock account, to plant account, to debtors account. What is the amount at which I'm supposed to transfer them? I'm supposed to transfer them at the book values. So I can see that investment is 80,000, plant is 1 lakh. 80,000. Plant is 1 lakh and stock happens to be 40,000 and debtors 50,000. Stock is 40,000, debtors 50,000. Once you transfer the assets to the realization account, just add them and write the total in the outer column, and then transfer the liabilities to the realization account. If you see in this question, we have under the liability side of the balance sheet, we have capital, general reserve. All these are not supposed to be transferred to realization account. Only external liabilities are supposed to be transferred to realization account. and provision for doubtful debts and investment fluctuation fund are to be transferred. I'll let you know when we solve problems with those adjustments. I'll let you know. But in this question, we only have one external liability, which is creditors for 60,000. So we'll transfer the creditors for 60,000 to realization account. And it will be transferred to the credit side of the realization account. 60,000. Understood or not, my dear children? So now that we have transferred all the assets and liabilities, it's time for us to sell the assets and realize them. When you sell the asset, you get money in the bank. So bank account will be debited and it is an income for the firm. And therefore, the only nominal account that is available during realization, which is during dissolution, which is realization account, will be credited. Income has to be credited a nominal account, and the only nominal account that we use during dissolution is realization account. So it will be credited to realization account. The journal entry is bank account debit to realization account. So when we post it to the ledger, we'll write by bank. In order to show how much is each asset realized, what we will do is we'll below bank account, we'll write the name of the assets and write the amount realized by those assets in the inner column. So we have debtors, plant, and stock. I'm writing only these at this point because in this question, the first point says that the following assets realized: debtors, stock, and plant, and they realized 40,000, 50,000, and 40,000. Stock realized 50,000, and plant realized 60,000. So now that we have realized the assets, this second point also talks about realization of assets, but it is not actually selling the assets, but we are giving it up to the partners. The partners are taking over the asset. 25% of the investment was taken over by Vandana for rupees 18,000, and remaining investments were taken over by Archana at 10% less than its book value. Whenever such split up comes, you actually split up the amount like this and calculate. The total investment according to the book balance sheet was 80,000. Out of this, 25% goes to Vandana and she's taking it for 18,000. No computation required here because they've given the value at which Vandana took over the investments. And the remaining 75%, which is total 80,000 into 75 by 100, that happens to be 60,000, was taken over by Archana at 10% less than its book value. So 10% less now. 60,000 10% is 10% of the book value. That is the discount we are giving. So 10% less than book value of 60,000 is 6,000, which is 54,000. So Archana is taking the remaining investments for 54,000. Now, how we're going to account for this is, I hope you understood the computation. In case you didn't, just rewind and see, you should be able to understand. Okay. So when the partner takes over the investment, usually you see when you sell the investment, the journal entry is bank account debit to realization account because you get money in the bank. But when the partner takes over investment, the partner would not give money to the firm. Instead, they would want it adjusted from their capital account. So when the partner takes over an asset, the liability of the firm towards the partner reduces and the partner's capital account gets debited. Understood? Therefore, the journal entry will be partner's capital account debit to realization account. And here it is by Archana's capital account and by Vandana's capital account. Both of these being were related to investments. We know that the question says that 25% of the investments are taken over by Vandana at 18,000. So Vandana took over the investment at 18,000. I'm just going to write 18,000 in the outer column. And Archana, we just computed it to be 54,000. Am I right or not, my dear children? Now, once we are done with all the adjustments given in the question, we cannot directly go to the next part. We have to go to the balance sheet one more time and check if we have realized all the assets or not. Understood? So we have realized investment as given in the question. we have realized plant, we have realized stock, we have realized debtors. All of that has been given in the question. Cash and bank should not be realized. It is not even taken to realization account. Now, why should we see that? Sometimes they might not have given the realization value of a particular asset in the question. In that case, what you've got to do is you have to check if that particular asset for which realization value has not been given in the question, like this. Here they've given the realization value. If they are not given the realization value for any asset, then you check if that asset is an intangible asset or a tangible asset. If it is an intangible asset, the realization value will be nil. You'll assume that if nothing is given in the adjustments, you're supposed to assume that the intangible asset realized nothing. But in case if it was a tangible asset, then the realization value will be the book value. So you have to realize the asset at the book value. You're supposed to write by bank and then write the book value in the realization account. But in this question, that is not the case. As you can see, all the realization value of all the assets have been given, so we don't have to bother about it. But when we look at the liability side of the balance sheet, we have creditors. The settlement value of the creditors has not been given in any of the adjustments. If the settlement value of a liability is not given in any of the adjustment, you're supposed to assume that the liability was settled for the full amount, which means we paid creditors rupees 60,000. So the next thing to do would be to pay the liabilities, and in this case, it is through bank account, and the amount of liabilities is 60,000. And then we move on to the last adjustment given in the question, which is expenses of realization. When it comes to expenses of realization, you're supposed to see if it has been borne by the partner or if it has been borne by the firm. If you look at this question, they are not told that the partner bears the realization expense, and therefore, whenever the question is silent on who bears the realization expense, you're supposed to assume that the firm bore the realization expenses. So firm bears the realization expense, but it was paid by RP. Whenever the firm bears the realization expense, it is an expense for the firm, and if it is paid by a partner, the partner has to be made good for the expense paid by her for the firm, and therefore realization account will be debited, and the liability towards a partner is increasing, and therefore partner's capital account will be credited. And when you write it in the realization account, you'll write to RP's capital and within brackets write realization expense to for the purpose of showing that it is this particular debit is for realization account. So that 20,000 is accounted. Now with this we have accounted for everything here in the question. Understood or not, my dear children? And we see that the debit side total is 3,50,000 and the credit side total is 1,32,000, which means that the debit is more than the credit. Oh, wait a minute. We have to add all this in right here. Yeah. So the total of the amount realized as assets, we had written it in the inner column individually, but we have not written the total. I just did that. We see that 2,82,000 is the liability credit side total. So it's actually a loss because the debit side is more than the credit side. In a nominal account, if the debit side is more than the credit side, it's a loss. So the loss will be divided amongst the partners by partners capital account. And under that we have Archana, Vandana, and Aarti. The profit sharing ratio between Archana, Vandana, and Aarti is given in the question. It is 5:3:2. We will divide the profits in that ratio. Loss is in the ratio, and the loss happens to be 68,000, 3,50,000 minus 2,82,000 divided in the ratio, profit sharing ratio, 68 into 5 by 10, 68,000 into 3 by 10, and 68,000 into 2 by 10. And with this, my dear children, we have come to the end of this video. It's as simple as that, my dear children. What did we do from the beginning? Let me just check if the answer is correct. Yeah, it's correct. So what did we do from the beginning? We transfer the assets to the realization account. Then we transfer the liabilities to the realization account. and then we realized the assets. We accounted for any asset taken over by the partner. We accounted for liabilities being settled, and then we accounted for the realization expense. And that's it. After that, we tallied the ledger to find the profit or loss on realization, and that was it. With this, we have come to the end of this video, my dear children. We'll be solving more realization account problems with a lot more adjustments, with a lot more complicated adjustments. Please do share, subscribe, and let your friends know who are preparing for board examination. This might be useful. Once you go through the videos in this playlist, you should be done with all the previous year questions and sample question paper questions. Thank you so much. See you in another video with another question from the previous year. Take care and bye.